Today on Retire with Purpose, we discuss retiring inspired with Chris Hogan, fake news about retirement, and tax strategies for couples.
Welcome to Retire with Purpose, a show specifically designed to help you maximize your financial confidence in retirement. Casey Weed is the CEO and Chief Visionary of Howard Bailey Financial, a certified financial planner and Wall Street Journal best-selling author. He's your host on Retire with Purpose.
What's it like to work because you want to, not because you have to? Well, according to our guest today, it's kind of magical. I'm Lee Kelso. This is Casey Weed. He's a certified financial planner, president of Howard Bailey Financial, best-selling author, and host of the Retire with Purpose podcast, where he recently talked with Chris Hogan. And if that name sounds familiar, it's probably because you're a Dave Ramsey fan, right, Chris?
That's right. You probably know Chris Hogan largely because he's one of the most notable financial coaches for the Dave Ramsey Solutions team. Maybe you've read one of his books. We're going to have a special offer for his best-selling book, Retire Inspired, in just a moment. Maybe you also caught one of his shows, The Chris Hogan Show, The Chris Hogan Podcast. He was one of my favorite guests of all time. I think you'll really enjoy some of the clips that we're going to share with you here. And off the top, we wanted to share with you our conversation about being job optional. What does it mean to become job optional? Well, that means that you know that you have everything you need, that you could retire at any time. You have financial independence, but you continue to choose to work. I had to ask Chris, what does that change in someone's psyche when they become job optional?
I can totally tell you the difference, and it's called joy. Joy, that's what I see when people reach that job optional status where they're not working because they have to, but they're working because they want to. They love what they do. They love the people that they're working with, and they love the idea of making an impact. And I'm going to tell you, those people are magnetic. You love to be around them, right? Because they're not seeking to take, they're bringing and they're giving. And so I think it's something about their spirit, but I would say joy is the thing that I've noticed as the difference.
That is so true, and such the big shift that I see in individuals that'll come in and say, I'm ready to retire, I hate my job, I want to sell my business, but as soon as they realize that they don't need to make another dollar, now there's a shift. It becomes about giving back. It becomes about giving back to your team, your community, your clients, those around you, your family, and it really just creates that joy that Chris talks so fondly of here. I also wanted to talk with Chris about seeking financial advice. That's one of the things he covers a lot in his programming and in his book, Retire Inspired. Why should we all be seeking financial guidance, and who should that individual be?
You see, I think when we have our dreams clear and we have a plan that's clear, that's an opportunity for us to do something. It's an opportunity for us to make an impact. But if we don't engage in this and we don't sit down with investment professionals to talk about our portfolio, to find out some things that we could do to go further faster, that's where we're leaving things to chance. And so I want people to grab opportunities. And that's not to be scared to ask questions, not to be scared to have a conversation. You know, Casey, you're in the industry, and most people believe that if you go sit down with an investment professional, that they're going to judge you. Right? They're going to put their glasses at the end of the nose and look at you almost like a principal and tell you everything you've done wrong. No, those are the wrong ones. You don't want those. You want to sit down with people that are SmartVestor pros. These are people like you, Casey, that we talk about all around the country that have the heart of a teacher. They're not there to judge you. They're there to actually help you get to your goals.
I love that. I mean, it's just so true because most individuals don't seek financial advice because they're afraid of being judged. And I think the world of financial advice needs to shift. It needs to be a judgment-free zone. Another thing that Chris shared with us is just why you cannot leave your future up to chance.
The financial industry has so many acronyms, so many definitions, and so much stuff out there that it can actually cause people to have fear. And people tend to avoid what they fear instead of engaging it. And I'm amazed that if I have a tooth problem, I assure you, Casey, I'm going to a dentist. All right. And if I have a vehicle problem, I have basic tool skills. I'm talking hammer and a screwdriver, the flathead kind, not even the Phillips. I can't operate that thing. Right. If I have car issues, I go see a mechanic. Well, listen, we're talking about your dreams here. We're talking about your livelihood and your family and the potential for you to impact your community. That's a pretty big deal. So let's not leave that to chance. Just like you'd go see a dentist for your tooth, just like you'd go see a mechanic for your car, you need the right kind of investment professional in your corner to help you realize your dreams.
I love this about Chris. Him and I had this in common, that neither of us are real mechanically inclined or mixer fix-its around the house. I grew up with a dad that didn't teach me how to change oil. He taught me about financial planning, and he taught me about how to manage money well. And those are all good things, but we always need to find the best professional for the job. I remember one time I was changing lights in the house when Dad came home for the holidays, and he said, "What are you doing? You're going to electrocute yourself. Call somebody that knows what they're doing." And that's exactly what I ended up doing. And thank goodness I did before I hurt myself. Another thing that I have to talk about, anytime that I'm on a call or an interview with one of the members of the Dave Ramsey Solutions team, I need to talk to him about a couple topics that are kind of central to the whole philosophy that Dave brings to the table. And that is usually debt. It's budgeting, for that matter. And in this case, I wanted to cover carrying a mortgage into retirement, because many times we say, well, you should never carry a mortgage into retirement. We hear this time and time again. But now in today's low interest rate environment, does that continue to hold true? Let's see what Chris has to say.
I think you have two sides, right? You have the can you or should you, right? And I think you also, the difference is, one of my football coaches told me, he goes, guys, he used to teach this to us all the time. He said, there's good, there's better, and there's best, right? There's a good time, there's a better time, and there's a best time, right? And so this boils down to, should you go into retirement with debt? Well, the best case scenario, everyone would answer that, is no, right? You free up your income, you can do more of the things you want to do. Do people do it? Yes, they do. But you know what? That's their individual plan. That's them walking through and talking and understanding where they are, what they're doing, and their overall game plan. I encourage people not to go into retirement with their mortgage. If at all possible, just get that out of your life, free up that payment, and now you can invest more and do more giving in the future. So, I tell people they reserve the right to be able to choose. I just go back to good, better, or best. And I want people thinking like that. But more importantly, if they're married, working together along with the SmartVestor Pro, understanding the overall strategy.
Yeah, I like Chris Hogan a lot. He does a great job just getting it down to the bottom line, doesn't he, Casey?
Oh, I really enjoy that conversation with Chris. We also talk about how other strategies for those individuals that maybe shouldn't pay off their mortgage and why that's the case for them, and a myriad of other topics that I just think are so impactful, especially when you hear it from that deep voice.
Yeah, that's a heck of a voice, isn't it? Well, Casey's put together a special deal with Chris Hogan, and it's one that you're going to benefit from. So if you can be one of the next 10 callers, you can receive a copy of Chris's new book, Retire Inspired. This book is all about viewing your retirement as a financial number instead of an age. Chris equips you with a plan to make your own investing decisions, set proper expectations for the family, and how to build a dream team of experts so that you can live out the best second act in your life. Chris sent a box of books to Casey and the Howard Bailey team, and they're giving them away till they're all gone. So you just be one of the next 10 callers at 866-482-9559, and you'll receive a copy of Chris Hogan's book, Retire Inspired. When we come back, Marshall Johnson, the vice president at Howard Bailey, joins Casey to talk about financial fake news. Is it real? We'll find out.
Hi, Casey Weed, president of Howard Bailey Financial. Planning for a secure and independent retirement requires staying on top of the latest trends. New retirement regulations, trillion-dollar stimulus packages, and a pivotal election year all need to be taken into consideration. The Howard Bailey team is here to support you. We develop retirement plans driven by meaning and purpose, so you can stop worrying about what's next and focus on what means the most to you today. Call now for a complimentary consultation and a customized plan of action. Is there fake news out there about retirement? Well, I'm here with my good friend and personal financial planner, Marshall Johnson, to help us find out. We're going to be covering an article that came from Forbes titled, "Do You Believe Fake News About Retirement?" This is one of the 4 articles that we send out every single Friday, and we cover this very article on our podcast. We're going to touch on it here, but you can go back, listen to episode number 151 to get the full story and a link to this very article. While you're at Retire retirewithpurpose.com. Make sure you scroll on down and click to sign up for weekend reading. First name and email will get the ball rolling for you. So Marshall, why did we pick this article?
You know, Casey, it's pretty much the whole reason why we do weekend reading for retirees, right? There's so much information out there. There's so much stuff to consume on a topic like retirement. Some people don't know where to look and what's real and what's not real, and who do I ask?
Oh yeah, there is so much garbage out there, and yeah, there's a lot of this fake news talk going around these days.
Yeah,
so
sure.
It's a good little thing for us to cover, I think, in the financial world as well as the political realm, because it does apply to virtually every piece of news that you consume. You need to make sure you understand your source. You need to make sure that what you're getting is the truth, because there is a lot of garbage out there. And so we're sifting through articles every single week on the latest investment strategies, income strategies, tax strategies, and it takes me a long time to do that, because as I'm going through these articles, I have to look at the source at the same time and validate that source. And what was interesting about this article is it did cover 10 different pieces of fake news, which was very valuable information. However, there was a little bias that was in this article at the same time, and there was kind of some fake news that you might have been able to gauge in the article, which I explained in my commentary, because if you looked at the source, you would find it was an individual or a company that really focuses on 401k plans, promoting 401k plans. So they have a bias towards 401k plans versus alternatives.
And I think that's a great point. You know, everybody, we all have our bias, right? We all have come from different backgrounds. We all believe different things. It's just being aware of your bias and making sure you include that in the decision-making process.
Yeah,
right?
I know that I personally have a bias to be very conservative in my approach to the individuals I work with and myself, but I know that and I'm aware of that, and I'm happy to disclose that at the same time. Marshall's quite the opposite, which makes him a perfect financial planner and partner for me, because he's a little bit more aggressive than I am. He'll slant more towards the equities, where I might slant more towards fixed income, and I need that balance in my life and in my financial life. There's a lot of great information in here. We're going to cover a few of these pieces of fake news for you. And these are questions that come up time and time again with families that we work with, because it's easy to hop on Google and all of a sudden you believe that Social Security is going to go broke, for instance, and that's the first piece of fake news that we want to cover with you.
Yeah, we get asked quite a bit, you know, is Social Security going away? I read my statement the other day. It sounds like I'm only going to get 25% of my current benefit by 2034. And now with all the stuff going on in the world today, they're predicting it might even be sooner than that.
Yeah, and that number's 75%, which it's okay. We can misspeak from time to time.
What did I say?
You said 25%, but that's okay.
25% reduction.
25% reduction,
Yeah, 25%
75% of our benefit. But that's a
there you
good point, because when we look at our Social Security benefits, man, we've got to look forward, and it does predict that the trust fund is going to go broke. However, just because the trust fund goes to zero doesn't mean that there's not going to be enough out there to pay out 75% of your benefits, roughly, or about a 25% reduction, but that's not a guarantee either. Historically, we've seen this before. I think many times we get in the news and it feels like, well, Social Security has never had these types of issues. It's all because of the baby boomers, but in reality, Social Security has had this very problem historically, and there's been changes at the last minute in order to fix Social Security. Now, this doesn't mean that this isn't something that you should plan for. We actually did another podcast on the topic of stress testing your Social Security benefit for different scenarios, because there will be changes to Social Security. I don't know that they'll impact individuals that are already on their benefit. Historically, it's been sunset, and that's most likely what's going to happen again.
Future generations may take the heat, or taxes can go up. There's a number of ways to fix the problem. I think that's what we have to understand, is this is a problem that's very fixable.
And we've stress tested it with increasing taxes for individuals in their plan. We've stress tested it by reducing their benefit or delaying that benefit eligibility date. You need to stress test your plan in a multitude of different ways, not just when it comes to investment moves, the market and returns and inflation, but also when it comes to Social Security and tax rates.
And if you are somebody that has a bias, then definitely want to make sure that you're doing this, right? If you believe Social Security is going to be defunded or bankrupt, then remove it from your plan altogether.
Absolutely. And the next piece really does have to do with taxes. So another piece of the fake news in this article that we wanted to outline had to do with the concept that, well, hey, if I go ahead and I put dollars into a tax-deferred retirement account today, it's not going to make a difference because I'm going to have the same tax rate once I get to retirement. Now, that may be a reality. It may be true that you're in the 22% federal bracket today, and when you get to retirement, you're in the 22% federal bracket. Let's just focus
or eventually.
Let's just say that's the case, that it's 22 today, it's 22 in retirement. You're still benefiting from the tax deferral, the compound interest that you're able to accumulate because you have your principal earning interest, your interest earning interest year over year. And so you're able to see those things compound, didn't pay taxes, so your taxes that you would have had to pay, they're also earning interest. There is benefit to that.
That triple compounding.
Triple compounding.
But also, think about your standard deduction. Everybody's got a standard deduction that they get to deduct every year. Well, in retirement, if you're a married couple, $27,000 over 65, heck, that was money that you put into a 401k, never paid taxes on it, and you were able to pull it out tax-free in retirement.
If you're able to keep that income low enough, and this is why we talk about diversifying your tax buckets, having a 1099 bucket, a tax-deferred bucket, a tax-free bucket, because it's okay to have money in those 401k buckets, because you put those dollars in there, you don't pay taxes on them today, and as long as the distributions are managed appropriately, you might be able to stay in that 0% glory land in retirement. That is a reality for some individuals. The next piece of fake news in this article had to do with your money being all tied up in your 401k plan. And that's not necessarily the case. You don't put that money in there and it just disappears until you turn 59 and a half.
Yeah, you've got loans, you've got hardship withdrawals, provisions. There are ways to access first-time home buyers. There's a lot of ways that you can access those funds, and they may be appropriate and they may not be appropriate, but you got to know that there's some loopholes.
Well, and I'll also say, I think the bias in this article said, hey, you need to put as much money in that 401k as possible. Yeah, that's just not what I was taught growing up. My dad always said, hey, don't put it all in that 401k or that Roth IRA. Diversify those tax buckets, and it'll offer more flexibility, maybe even more growth down the road. Now, what if your income's too high? Can you still contribute to a Roth IRA? Many would say no, but that would be another piece of fake news.
Yeah, we hear it all the time.
Yeah. You still can, but you have to know the back door. And that back door would be contributing to a non-deductible IRA and converting those dollars to a Roth IRA. If these topics interest you, or you want to know what are the other, say, was it 7 more that we need to cover yet, you can check out the podcast, episode number 151, or you can also just read the article, which you'll find right there in the show notes at retirewithpurpose.com. We've got another special, very good offer for you today, and that is an offer of Chris Hogan's book. We spotlighted Chris Hogan on the podcast, and now he has offered to deliver a bunch of books out to the families that trust us for their guidance. All you have to do is call the number on your screen. We're going to hand out 10 copies of this book, and we'll continue to do that until they're all gone here for the next 10 callers. So call us right now, and we'll deliver that book to your doorstep. Just call the number on your screen. In just a moment, we're going to be discussing tax strategies. We're also going to be covering retirement income strategies while we answer questions from you, so stick around. Hi, Casey Weed, president of Howard Bailey Financial. Planning for a secure and independent retirement requires staying on top of the latest trends. New retirement regulations, trillion-dollar stimulus packages, and a pivotal election year all need to be taken into consideration. The Howard Bailey team is here to support you. We develop retirement plans driven by meaning and purpose, so you can stop worrying about what's next and focus on what means the most to you today. Call now for a complimentary consultation and a customized plan of action.
You guys have come through some great questions for Casey to answer, and if you'd like to have one of your questions answered on the program, just go to retirewithpurpose.com, scroll down, you see a little text window, put your question there, it will come to us, and we might reach out and ask you to be part of the program. That's what we did with Cindy in Goshen.
Are there tax strategies that couples should use while they're both living so that when the inevitable happens and one person passes on, the widower and single filer is best positioned for the future?
Oh boy, Cindy, you must have a wonderful marriage, I'm guessing, because you're actually thinking about each other in the future when one of you are gone. This just doesn't happen that often. I have to say this is something that most just aren't thinking about because it's so easy to just go back and look at our tax return from the previous year and make changes this year based on what happened last year when we were married, not realizing that we probably won't be married forever because one of us is going to pass away first. When we interviewed David Bach, New York Times, I think 9-time New York Times bestselling author now, on the Retire with Purpose podcast, he shared a really scary statistic. He said 80% of men will die married. Well, what's that mean? That means the majority of women are going to be single filers at some point, and 80% of men will never know if that retirement plan they put together is actually going to work out, but their spouses will. And that is not just about the financial plan. It's not just about picking the right financial planner for both of you and both understanding that plan, but it's also about finding the right tax strategy that's going to succeed in the future, regardless of who passes away first. Because of that single filer status, you could be paying twice the marginal tax rate for the individual, the survivor, as you did while you were a married couple, and still have the same amount of income, especially because if you have a lot of IRA assets, tax-deferred assets, they are then inherited by the surviving spouse, and the RMDs continue to come out year after year. And so we need to make sure we're really paying attention to these things, and there are things that you can do. I think the most common thing that is done and can be done is trying to eliminate that tax-deferred asset, or as much of that taxable income as you can while you're married, and that can come in one form, such as Roth conversions. You could be converting strategically every single year a portion of your tax-deferred account to a tax-free account, moving funds from the IRA to the Roth IRA, paying the taxes today in lieu of potentially higher taxes in the case of a surviving spouse, especially if that surviving spouse lives for another 10, 20 years, and in some cases that does happen. Another thing that you should pay close attention to would be account titling, and this is very important if you have two spouses that have very different ages, a large disparity in their age. So we recently helped a couple where the husband was terminally ill. So the husband is terminally ill. They know that he is not going to live past his wife, right? He's probably has another year or two to live. Now, they had most of their assets in a joint account. Most of those assets were in highly appreciated stocks. Now, if they see those, if he passes away, they'll receive a step up in basis on half of the assets as they pass on to that surviving spouse who's younger and is also not terminally ill. She will end up with those assets. Now, in this case, what we did is we retitled the account and made him the individual account owner, took her off. Now, this is what the rules are in the state of Indiana. Now she will receive a full step up in basis. So all that appreciation will now essentially go away because her cost basis will be the same as the date of death value. So she can then sell those assets when he passes away and not have to worry about capital gains at that point in time. This is one of those things that's so often not thought about. Pay attention to your state-by-state rules. It depends on if you're a community property state or a common law state, and make sure you're always consulting with your CPA when it comes to any tax strategy decisions.
Let's jump over to Columbia City and Jeff and his question about saving for retirement.
What are your thoughts on whole life insurance? Is it a good strategy to help save for retirement?
Ooh, Jeff. So this is a question I'm glad you're asking, and it's one that does concern me because I've had friends that have fallen into this trap. I have a friend when I was younger, so in my early 20s, he was in his early 20s, wasn't married, didn't have any kids, wasn't putting anything into his employer's retirement plan yet, and another friend of his came along and said, hey, you need to buy whole life insurance. It's going to be a great retirement strategy for you in the future. And what is it? Well, whole life insurance, yeah, the funds are going to come back to you tax-free, but it's going to have returns much like a CD, right? It's going to have CD-like returns. If you think of, it's going to be the most conservative cash value life insurance option you could have. Whole life insurance, kind of like a CD. Variable life insurance is more like investing in the market. So maybe whole life insurance nets this individual 3-4% per year. Should a 20-year-old, first of all, should they have life insurance in the first place if they don't have any kids, they don't have any family, they don't have any debt, probably don't have nearly the need for life insurance insurance as they do to just save. He needed to build his emergency fund, and he needed to be saving in places that could generate as high of a return as possible. He was in growth mode. He was in accumulation mode. Now, at a certain point in our lives, our goals shift a little bit. We start running out of different places to save funds. So I don't have a problem with whole life insurance. I don't own any whole life insurance. In full disclosure, I own index universal life insurance, term insurance as well, and guaranteed universal life insurance for myself. I think there's places for those things that are more flexible than whole life, that'll generate higher returns than whole life insurance. So evaluate all of your options. But initially, yeah, maybe we need life insurance. We should buy a term policy. But when it comes to saving and accumulating assets, we should start with the most tax advantaged places with the best growth rate. The most tax advantaged account you have is your HSA. If you have access to an HSA, we start there. Then maybe you want to save some money for college. Maybe it's your 529 plan that you're putting funds away for, maybe yourself, your kids, and then you're putting funds into your 401k, making sure that you're getting that match every year, that guaranteed return. So now we've saved dollars in all the places that we can to offer tax advantages, and now we have to start getting more creative. Maybe then we turn to cash value life insurance. Those are the things that I did in my financial life, going from term insurance to Roth IRA to HSA to maxing out that 401k, and then I go, oh no, I don't have any place else to go where I can go for tax-free growth. Then I fund cash value life insurance, and now I do that every year. I don't use whole life insurance. I don't have anything against it. I just think that there's better options out there today. Just again, evaluate all of your options.
Jonathan from Huntington checks in by email saying, I'm low income, making about $35,000 a year, and I'm 40 years old. I don't want to rely only on Social Security if and when I get to retire. What kind of buckets should lower income people be making to increase income at retirement?
Well, in lower income brackets, you have to be contributing to a Roth IRA, in my opinion, because you're paying so little in taxes. And the likelihood is not just that taxes are going to go up, but if you're younger and you're lower income, you're probably going to see significantly increases in your income over time, which means you're going to pay higher taxes in the future. I want to see you stuff those dollars into your Roth IRAs, as I said, your HSAs, as I said as well. So look for those tax-free places, and you need high growth and low cost. So high growth, low cost, low taxes, those should be the focuses. And more than anything else, you should be focusing on increasing that income at all costs. That'll be the biggest boon to your retirement future.
Hey, before we go, I want to give you another chance to get in on today's special offer. Casey has partnered with Chris Hogan so that you can have a copy of Chris's book at no cost. The book is called Retire Inspired. It's all about viewing your retirement as a financial number instead of an age. Chris equips you with a plan to make your own investing decisions, set proper expectations for your family, and how to build a dream team of experts to help you live your best second act of life. Now, Chris sent a case of books to Casey. We're giving them away till they're all gone, so I hope you're one of the next 10 callers at 866-482-9559 so you can receive a copy of Chris Hogan's book, Retire Inspired. All right, we'll see you next week.